Hello everyone and welcome back to Girard's Investment Video. I'm Chris Briscoe, Vice President and Wealth Advisor, and joining me in the studio is Chief Investment Officer Tim Chubb. Welcome, Tim. Good to see you in person.
Good to see you, Chris.
Tim, as we were reviewing topics to discuss today, we decided to ask our wealth advisors what they were hearing when they talk to clients and other prospects. And one of the topics that keeps coming up, especially this year, is fixed income and what role, if any, it plays in a portfolio. We're looking at rates now. Of course, they're at historic lows. They've been there for quite a while. Over a decade ago with the global financial crisis, last year with the COVID-19 pandemic, it doesn't seem like there's much more room for them to go down, right? On the other side, bond prices are high. As we know, the relationship between bond yields, bond prices is an inverse relationship. So investors aren't going to see those robust total returns that maybe they've seen over the past 30 years, at least not for the next couple of years as the economy continues to recover and benchmarks keep rising. So it's a legitimate concern and it's a good question. What role, if any, do bonds, fixed income play in a diversified portfolio?
Yeah, it's a great question and one that we've really been wrestling with for the better part of, it seems like the last 15 years, coming out of the global financial crisis. And when we talk to clients about that, that we hear that from clients, that question, I think oftentimes they're really considering the core investment grade, treasury exposure, the investment grade corporates, the investments that are certainly very important to have as a part of the core fixed income within the a well-diversified portfolio. But typically that's not all that we're just investing in. And I understand where the question's coming from. You see the 10-year treasury at 1.3%. You see the 30-year come under 2. It's very difficult to feel comfortable investing in some of those areas when you're expecting that interest rates will rise. But traditionally, this sleeve within the fixed income portfolio has served as really it's done its job as a ballast, as ultimately trying to tamper down some of the equity exposure, or the equity volatility, the stock market volatility that comes on the other side of the portfolio. And so, when we go through violent pullbacks like we did in the fourth quarter of 2018, like we went through in the first and second quarter of 2021, where the stock market was selling off, this area of the portfolio really did its job to serve as a hedge, an uncorrelated asset, to allow us to take advantage of the stock market pullback. As those assets were rallying, we could sell them and buy stocks, just as we're doing now. As the stock market's reaching all-time highs, we're selling stocks to make sure that we're properly allocating from an asset allocation perspective to this area within the portfolio. And so I oftentimes use the analogy that this piece of the portfolio is like the vegetables within the food pyramid. Really important to have, maybe not so much fun to eat for all of us, but it's really critical for a well-balanced diet. And so it's not one to forget, but ultimately provides that hedge that we're looking for to dampen that stock market volatility. And ultimately, diversification and asset allocation don't work when you're not rebalancing. And so it's so important to have a piece of the portfolio that isn't like the rest of it, which is typically your equity exposure, to rebalance to and from during periods of weakness.
And that's where financial planning is such an important part of the process, as eating your vegetables, where if you can have proper allocation that matches with your risk tolerance and your overall goals, you can adjust your portfolio and make sure you have the right amount of stocks and the right amount of bonds or fixed income in there. Thinking about last year, if somebody who is 100% invested in the stock market needs to draw down some income from the portfolio and the market's down over 30%, that's a tough conversation to have.
Absolutely. It even goes back to clients that we work with, endowments and foundations that have capital projects, or a pension client of ours that ultimately is trying to hit these assumed rate of returns. And so if you don't go through that financial planning process, regardless of who you are, again, corporation, endowment, private wealth relationship of ours, you're not going to understand just how you can hit the assumed rate of returns. And what we oftentimes find is maybe the fixed income exposure that you thought you might have needed is not necessarily needed, when you go through that exercise, just because you have, a favorable financial plan and you can take more risk on in the stock market. But I think it's still very important to have that balance within the fixed income allocation.
Yeah, and staying on fixed income, a lot of clients sometimes look at bonds as just treasuries and investment grade bonds, right? But aside from that core portfolio, what should investors be aware of in fixed income?
Yeah, I think taking a step back, when we think about our fixed income portfolios, our goal is to have it serve as a ballast and also keep up with inflation, and also ultimately manage the two risks that aren't often talked about in the financial media, which are interest rate risk and credit risk. Interest rate risk is the risk that if a company were to issue a bond, say at 3% today, that when they go to issue more debt, 5 years from now, that it might be up at 5%, and who's going to want to own that 3% bond anymore because interest rates have risen. And so when we're going through an economic environment and recovery like we are right now, interest rate risk is much more important to us as we're building out that fixed income allocation than, say, credit risk. Credit risk is something that is very important when we're going through periods of economic uncertainty like we did last year. But during times like this where rates are rising, it's almost, and we've reflected these views within our clients' portfolios, more credit risk is, good to have because they ultimately provide much more of a hedge. They yield much more as far as income is concerned. But we often think of it as a dimmer switch as far as, how much credit risk and how much interest rate risk we want to present into the portfolio from a duration perspective. And so ultimately, junk bonds or below investment grade corporates, bank loans, they are important to have within a fixed income allocation. They provide more diversification from just core bonds, but they also present more risks that ultimately mean that they're a bit more correlated with the overall stock market. And so it's important to have that mix and realize that you want to have that fixed income or bond exposure be a ballast, but you also want to make sure it's keeping up with inflation and providing our clients some income generation for those, especially in retirement. And so thinking about things a little bit more holistically is extremely important in the bond market. It's not just, like you said, the plain old treasuries and investment grade municipal bonds. They serve a place in the portfolio, but how much you allocate to that sleeve should be adjusted throughout market cycles.
And it's key to remember that every client's different, every portfolio is different, and how they need to be allocated.
Exactly. I think at the end of the day, you don't want to abandon that ballast within the portfolio. You may want to think about how much you're allocating to it, bring in some of these other risk asset classes within your fixed income portfolio, go through that financial planning exercise to see if you can take on more equity risk. But there's no silver bullet. The alternatives to that core bond, it's cash, it's money market funds, it's CDs. All those are pretty much guaranteed to provide a real return of a negative real return after inflation. Whereas we think that even in this difficult environment, our fixed income sleeve can keep up with inflation.
Great. And as always, Tim, thanks for your insight. We appreciate it. That's going to do it for us today. Be sure to tune into our quarterly Investment Currents live call, where we will review the third quarter of 2021, as well as talk about expectations for the remainder of the year and beyond. Until then, please make sure to visit our website, meetgirard.com, for some great articles and content, and do not hesitate to reach out and let us know if we can help in any way. Thanks for joining us. Take care, and we'll see you soon.